In today's video, we're talking about how a handful of Chinese car makers quietly raced past Tesla on one of the most important scoreboards in the auto industry, profitability. A new breakdown of first quarter 2025 earnings shows BYD at the head of the pack, Geely hot on its heels, and four Chinese brands posting fatter gross margins than Elon Musk's company, something almost unthinkable just a couple of years ago. All the sources I used are linked in the description. To understand why this matters, let's start with the headline numbers. BYD booked a single quarter net profit of 9.1 billion yuan, roughly $1.28 billion, and did it with a 20.7% gross margin, easily topping Tesla's 16.3% showing for the same period. The result marks BYD's seventh straight quarter north of the 20% line, a level many legacy automakers still dream about. That margin strength is even more impressive when you see where the cash is going. BYD plowed 14.2 billion yuan, about $2 billion, into research and development in just one quarter. In fact, BYD has spent more on R&D than it earned in 13 of the last 14 years, a relentless investment cycle that now powers everything from its Blade battery packs to its own roll-on, roll-off shipping fleet. Geely, the sprawling group behind Volvo, Lotus, Polestar, Lynk & Co., Smart, and Zeekr, grabbed the number 2 profit slot with 5.6 billion yuan and a 15.8% margin, basically on par with Tesla, while spending 3.3 billion on R&D. The numbers dovetail with Geely's blistering 48% jump in vehicle sales this year and its decision to fold Zeekr and Lynk & Co. into a new Zeekr group structure aimed at sharpening the premium end of its lineup. Third place went to state-owned SAIC, parent company of MG, which raked in 3 billion yuan but only managed an 8.1% margin, evidence that scale alone doesn't guarantee juicy profitability in the era of price wars. Great Wall Motors, Chang'an, Bake, Ceres, Li Auto, Leapmotor, and Xpeng round out the top 10, but the real eyebrow raiser is Ceres. Despite ranking 7th in absolute profit, its Aido-branded SUVs delivered a stunning 27.6% gross margin, giving the Huawei-backed newcomer China's fattest auto margin of the quarter. If you're enjoying the video so far, don't forget to hit that like button. Now, what's driving these gains? In a word, vertical integration. BYD builds its own batteries, semiconductors, and even cargo ships, cutting suppliers and shipping costs out of the equation. Geely has turned its Ningbo Super Campus into a conveyor belt for EV platforms that can be shared across half a dozen brands. Ceres taps Huawei's Harmony OS cockpit software, the same interface you'll find in millions of Chinese smartphones, which slashes infotainment development costs while letting Huawei foot much of the marketing bill. Tesla, by contrast, has spent the past 18 months slashing sticker prices to defend share as new Chinese makes flood the market, 169 brands at last count. Those cuts, plus the costly Model Y upgrade across 4 factories, chopped its gross margin from 25% in early 2023 to 16.3% this spring, the lowest level since 2019. CEO Elon Musk says he'll claw profit back through software and robotaxis, but investors won't see that windfall for at least another year. Meanwhile, China's automakers are conquering new turf abroad. BYD just rolled its first Dolphin Mini off an assembly line in Brazil and is finishing a passenger car plant in Hungary to sidestep EU tariffs. Geely will launch its own brand electric SUV in the UK later this year, and Chang'an says it will be in 10 European countries by 2025. Even latecomers like GAC's Ion and Chery's Omoda have sketched out European beachheads. That expansion pressure is already forcing Brussels and Beijing to negotiate floor prices to defuse a tariff war that could blow back on local suppliers. Back at home, price wars are ferocious, but Chinese brands have learned to protect the bottom line by mixing hybrids and plug-in hybrids with pure EVs. Great Wall's affordable Haval hybrids and Li Auto's 3-row range-extended SUVs fetch higher prices than small city EVs, which helps offset razor-thin margins in entry-level segments. Li Auto still posted a modest 646 million yuan profit on a 20.5% gross margin, proof that hybrids can buy breathing room until the charging network catches up outside China's megacities. Leapmotor and Xpeng haven't crossed the profit line yet, but both chopped their losses to a fraction of last year's thanks to double-digit gross margins and soaring deliveries. Leapmotor sold 87,552 vehicles in 3 months, more than it moved in all of 2023. And Xpeng's bet on a cut-price sedan called Mona looks set to push it over 100,000 quarterly deliveries next time around. Scale is everything when battery costs are still in flux. Another pillar of Chinese profitability is ruthlessly efficient supply chains. Battery-grade lithium prices are down nearly 40% year over year, and Chinese cathode producers are already running at surplus capacity. BYD's in-house LFP chemistry is down to around $55 per kilowatt hour at the pack level, and several Chinese cell makers are now shipping 460 watt-hour per kilogram solid-state prototypes to automakers for 2026 models. Those cost tailwinds feed directly into gross margin line items. Yet margin alone doesn't tell the whole story. Cash burn on technology is still brutal. Only Geely and BAIC actually spent less on R&D than they earned in net profit last quarter. Everyone else dipped into reserves. The unstated wager is that whoever wins the next generation of battery chemistry, autonomous driving stacks, and in-house chips will command Apple-like margins for years, a gamble that echoes the smartphone war a decade ago. Speaking of chips, Huawei's growing influence can't be ignored. Its Harmony OS cockpit platform and ADS 3.0 advanced driver assist suite now span Seres, Chang'an's DePaul, and soon BAIC's ArcFox. Huawei supplies the brain and marketing heft, while automakers handle the steel and seats, allowing both sides to share revenue without duplicating expensive software teams. That co-op model is one reason Seres can clear nearly 28% margin on the Aido M9. Internationally, the race is evolving into a three-tier contest, Tesla and BYD duking it out for the global BEV crown, a pack of cash-positive Chinese challengers led by Geely, SAIC, and Great Wall pushing into Europe and Latin America, and a fast-maturing group of startups, Li Auto, Xpeng, NIO, Leap Motor, fighting to prove they can live off their own balance sheets. That middle tier may be the one Western brands should fear most, because it combines Chinese cost discipline with marketing lessons gleaned from selling premium metal at home. For Tesla, the response is twofold: deepen the software moat and localize production even further. The Fremont, Shanghai, Berlin, and Austin plants all switched to a redesigned Model Y in record time, but the adjustment chewed up a chunk of Q1 output. Tesla says its Texas-built Cybertrucks and Austin Pilot robotaxi fleet will leverage an unboxed manufacturing method to shave factory capex. Yet those savings won't surface until 2026 production ramps begin. In the meantime, margins stay under pressure. On the regulatory front, Europe's provisional tariffs of up to 38% on Chinese EVs have jarred investors. But Beijing and Brussels are already hammering out minimum price deals to avoid an outright trade war. BYD's decision to build in Hungary and SAIC's MG plant in Germany are hedges against that uncertainty. The EU's real dilemma is balancing green tech goals with industrial policy. Tax Chinese cars too hard, and you slow EV adoption. Tax them too lightly, and local jobs vanish. Across the Atlantic, the US remains largely closed to Chinese EVs under the Inflation Reduction Act's strict sourcing rules, but Mexican assembly rumors persist. If a Chinese brand sets up just south of the Rio Grande, it could tap the US-Mexico-Canada agreement for tariff-free exports, a scenario Detroit hopes Washington will preempt with battery sourcing thresholds. Zooming out, Chinese brands now account for 62% of global EV battery capacity, 55% of global cathode production, and more than 2/3 of the world's LFP cells. That dominance lets them bargain hunt raw materials and keep price tags low even when Western rivals struggle with nickel and cobalt spikes. It also explains why a $12,000 BYD Seagull can be profitable, while most sub-$20,000 Western EVs are sold at a loss. The next flashpoint is software monetization. BYD's DiPilot driver assist and Geely's Flyme Auto ecosystem still lag Tesla's full self-driving beta in sophistication, but both plan subscription rollouts this year. If they can convert even 4% of owners to paid services, that could add a point or two to gross margin without touching hardware costs. In a world where hardware profits are getting squeezed, software is the new brake horsepower. Finally, keep an eye on the startup tier. Li Auto's range-extended SUVs have cracked the family hauler code, delivering the brand's first billion-dollar year in 2024 and putting it on track for 32 billion yuan in revenue this quarter. Leap Motor and Xpeng, each partnering with European giants, Stellantis and Volkswagen respectively, may use overseas distribution to goose volume enough to flip to profitability by mid-2026. So, where does that leave Tesla's margin crown? Short term, it slipped. Long term, the company still owns a powerful brand and the world's most mature charging ecosystem. But China's automakers have proven they can match or beat Tesla on battery tech, scale, and yes, bottom line performance. Expect the next couple of years to be a dogfight of price cuts, factory announcements, and software subscription teasers on every earnings call. All sources are linked in the description, including a video on how YASA's axial flux record will change electric cars forever. Thanks for watching.